Hi, thanks everybody for joining us today. My name is Tim Emanuel. I'm one of the vice presidents here at K Properties and Investments. And today for our weekly webinar, we're going to be jumping into some of the due diligence 101 issues that you should cover with hopefully K Properties representative on the 721 exchange UPREIT DST investments that we're seeing in the marketplace. Before we get started, I just want to go ahead and make sure that we cover the risks and disclosures. A lot of these pretty obvious, but we're going to go through them real quick too, just to make sure everybody's on the same sheet of music here. The information herein has been prepared for educational purposes only. DST 1031 properties are only available to accredited investors, which is generally described as somebody having a net worth of $1 million exclusive of their primary residence, or accredited entities, which is generally described as an entity owned entirely by accredited individuals and or with a gross assets greater than $5 million. If you're unsure, you should speak with your CPA or tax attorney to verify. IRC Section 1031, IRC Section 1033, and IRC Section 721 and Delaware statutory trust investments are complex financial tax concepts. Therefore, you should consult with your legal and tax professional regarding your specific situation. There are risks involved with investing with DSTs and with any other private placements. This includes complete loss of investment principal, illiquidity, tenant vacancies, interest rate risks, declining rental rates, basically anything that would be associated with owning and operating real estate. For an investor to qualify, there's also financial requirements and suitability requirements that must match the specific investments or specific objectives and goals, as well as the risk tolerances of the investors. It's important to diversify. We want to include the safety that could be in the hedging that can be found through diversification. We also want to mention that past performance is not indicative of any future returns. It's also important to read the private placement memorandum in its entirety and pay close attention to the risk section prior to investing. While due diligence is an important step in evaluating any investment, it does not guarantee success or prevent losses. All investments carry inherent risks. Let's see, we'll go down to the next section. Okay, so today we're going to be talking about the due diligence on 721 exchange UPREIT DST investments. We cover a variety of topics that are related to this across, basically a bunch of issues that we have found through many years of taking a look at UPREITs, 721s, which a lot of our DST investors are interested in. And so this presentation today is to kind of not only provide the basic level education for questions that you should be asking, but also to show how K Properties stands out and what we do to help our investors that are taking a look at these. So we're going to cover what is a 721 exchange, the two-step 721 exchange process, how a DST to a 721 actually works, and then we're going to jump in also to some of the hot button issues within 721s that are specific, potentially problems that you should address. For example, fixed versus adjustable rate loans, dividend coverage and the true yield, understanding how cash flow risks and REITs can work. We're going to look at net inflows. We're going to talk about the hidden fees and markups. We're also going to discuss tax protection agreements and the importance of optionality when you're looking at these. Yeah, let's go ahead and dive in. A little bit about K Properties. We are a national investment firm specializing in Delaware statutory trust investments for 1031 exchange investors. So far, we've helped, our team members have helped well over 2,000 clients purchase over 9,000 DST 1031 exchange and 721 exchange investments nationwide. And we are approaching participating in almost 40 billion of DST real estate investments. So what is a Section 721 exchange? The IRS code defines it and says Section 721 that no gain or loss will be recognized when property is contributed to a partnership in exchange for interest in the partnership. Okay, that's their definition of it. So what is the actual exchange exit strategy? It's a two-step process. And basically what happens is, your relinquished property is sold. and the investor sells that investment property with the intention of executing a 1031 exchange, okay? And the DST is a natural vehicle for this process to occur. So the property exchange for Delaware Statutory Trust interest, essentially what's happening is 1031 exchange funds are used to purchase the interest in a DST and then held for a period of time. The 721 exchange transaction op units are issued in exchange for those interests in the DST. The interest in the DST are contributed on a tax-deferred basis to the 721 vehicle's operating partnership in exchange for operating partnership units. So what is happening here? The property is being sold, a 1031 is happening, and the investor is going into a DST. And then from there, after a holding period, generally, which is going to be about 2 years or so, the 2-year hold allows the 1031 to be in place and for it to gain the blessing from the IRS. And then the sponsor company will initiate, typically around that time, a 721 exchange into a larger, what is usually going to be a REIT. And in exchange for the interest, in exchange for the funds and the DST, the investor is going to get operating units that relate to that REIT that they're going into. So here's a quick little schematic here of what that overall process looks like. You, the contributor, the investor, goes into the DST property, and then the DST via the 721 exchange, those proceeds are then moved into the greater REIT. So why does somebody do something like this? Well, typically you're looking for liquidity. That's one of the major issues, is that potentially, if a REIT, if everything's functioning correctly, the investor would then have the opportunity to be able to go into something where they have the option at a certain time to be able to start taking money out. And so we'll talk about that and dive into that a little bit more. But their actual interest in the REIT is determined by the amount of money they put in, which is exchanged into those operating partnership units. Okay. So one of the things to get into, and this is where K Properties steps in, because we have eyes on this. We take a look at this issue of going into a REIT from a little bit different perspective. K Properties, like we mentioned before, has been doing this for a very long time, and internally, our own due diligence process has kind of put eyes on some of the things that we're starting to see issues with, and that we want to bring to the attention of the investors. When you do a 1031, most of our folks are looking for, obviously, the tax deferral and the passivity of it, and the asset that you're going into. But when you complete a 721, you're ending up into a larger, conglomerate, this REIT, which has got a lot of other properties with all types of variables that are there. One of the things that we're going to do is to take a look at some of these issues that are commonly known to potentially cause problems. One of these problems that we know about already is debt. And if you've talked with a K Properties representative, you know that when we address debt, because we are risk adverse, we're going to take a very conservative approach to handling that debt. Well, within a REIT, there's two types of debt that you need to be aware of: fixed versus adjustable. Okay. And if you remember back to 2008, with the problems that adjustable rate loans caused for a lot of investors, probably even folks on this phone call here, this webinar here, you can understand why we're looking at it. Okay. So one of the things that we're going to pay attention to is understanding the REIT's debt profile. What is the total debt burden on the REIT? Okay. And from there, we're also going to take a look at the REIT and how much of that debt is fixed versus adjustable. And the reason why this is important is because if you're going into one of these investments and this is where your funds are going to end up, it's important to understand that amount of debt, whether it's adjustable or fixed, can also fluctuate. Okay, because potentially this is a long-term relationship. When you end up into a REIT, you cannot 1031 back out. Okay, it's the end game for those funds. So understanding what happens when your money is there is critical. And obviously one of the issues that we're bringing up here is how that debt can affect that. The risk of adjustable rate debts is rising interest rates. It increases the borrowing costs. Okay, potentially can then reduce the dividends and the financial stability of the 721 UPREIT. Okay. When you compare this from a leveraged REIT, you compare that to, for example, a debt-free REIT, the debt-free REIT carries no financial leverage risk. So leverage REITs are exposed to interest rate volatility and foreclosure risk. So you have to ask yourself, what's your risk tolerance? Can you handle the increased risk from adjustable rate mortgages on your investments? Or would you prefer to have more debt-free and lower risk investments? It depends on what your objectives are. Here at K Properties, we are going to help you, and we're going to work with our clients to actually track the 721 UPREIT sponsor companies, their debt levels, their debt maturity schedules, and the amount of debt that's floating versus fixed rate. And this is going to help you make a more informed decision. And the reason why it's so important is if you look at any commercial property for that matter, one of the biggest most complex problems that can create issues for investors is what happens to that debt during the holding period. And when you're in a REIT, and again, we just previously mentioned this is a long-term relationship, it's important to be very informed on what you're getting into. So we're also going to discuss the dividend coverage and the true yield, which we feel is a critical measure for our investors that are looking at doing a 721 exchange UPREIT. Okay. And the question here to ask is your REIT's dividend built to last? So one of the metrics that we're going to look at is called the adjusted funds from operation. And we feel that this is a true yield indicator, and it measures if the dividends that are actually being paid out to the investors are being actually funded by the earnings from the real estate, or are they borrowed funds and new investor capital? Okay. So the AFFO, the coverage, if it's below 100%, generally what that's going to mean is that the dividends are relying on debt or new investor capital. Okay. And so it becomes a big red flag when dividends, and dividends are an illusion when we start seeing the opposite happen here. And this is typically going to be, REITs paying unsustainable, inflatable dividends that are just not built for the long haul. I mean, it serves a reason if they're putting out more money than they're taking in, you're seeing cracks in the foundation. Okay. And so when this occurs, it can also mask instability with greater issues with inside the REIT. So relying on outside funding in these REITs signals the potential of future dividend cuts or liquidity issues. When you're in a REIT, when you're in any of these investments, the sponsor company has the ability to potentially cut those dividends if there is a liquidity issue or a problem. Okay. And so you can get ahead of this by, talking with your representative about what some of these metrics and what some of these numbers look like when you are targeting a REIT or a DST that potentially is going into a REIT. We can get ahead of it by taking a look at what the numbers are showing us now. Is it an accurate picture of what's going to happen in the future? Who's to say? There's a lot of black swan events that could pop up. Take a look at the recent volatility and the changes we've seen on the economic environment from on a national scale that have been occurring over the last couple of months. And these situations were not necessarily expected. So if we can go into these types of decisions and complete these types of exchanges with eyes on how these REITs are actually functioning now, if we're seeing problems or seeing strength, it would be important to understand that because we don't know what the future is going to hold. So the 721, the tip here is avoid making, what we like to say is avoid making critical decisions based solely on your relationship with a financial advisor or the REIT, the potential REIT sponsor company they're going to, their impressive size and scale. And these decisions need to be made on the REIT's actual financial performance. And the reason why we're saying that and the way that we feel this is a safeguard for investors to go into these things eyes open is because what we're noticing is a lot of the larger institutions, the big wirehouses and whatnot, they have a limited supply of DST and REIT options. And some of these, when we kind of dive in and look underneath the hood, they're not necessarily set up for sustainable, what we feel are going to be sustainable long-term stability. There's cracks there. And we can dive into a little bit more about that and just over the next slides here. One of the things that we're looking at, and one of the reasons why, one of the things that we are seeing that is potentially an issue right now is the net inflows versus outflows. Okay. It's important to understand how cash flow risks can impact REITs and their stability. Okay. So a simple example, a REIT raises $50 million. Okay. But let's say they raise $50 million in year 2024, but they're going to see, let's say hypothetically they saw $200 million in withdrawals. Okay. So that means it has a net outflow of $150 million. This creates a massive liquidity issue for investors that are trying to get their money out. Again, one of the number one reasons that we mentioned ahead of time that you would want to go into a REIT and want to do a 721 is the potential for liquidity, right? So if the REIT gets into a situation where outflows are far exceeding the inflows, they might be able to pay and support that for a certain amount of time, but eventually they're going to have to probably cut those cash flows and start denying the liquidity requests that are coming in from investors. So it's something that you should be aware of. Now, these statistics and the numbers that are related to this are published. We pay attention to it. We actively track it. So we can see on a quarterly basis for most of the REITs, we can see, are they keeping up or are they experiencing more outflows than their inflows, which would signal that potentially liquidity could be a problem in the future moving forward. Again, this is a great thing to bring up with your K Properties rep. These are active metrics that we follow, like I said before. It's something that we are paying attention to because, ultimately, when you go into one of these investments, if the ultimate plan is, a couple of years down the road to have a liquidity event or the ability to take money out, and then all of a sudden, maybe 3 to 4 or 5 years down the road, the economic picture doesn't look as rosy as it did before. This is something to consider. We don't know what's going to happen in the future, but if we're seeing, if we have a need for liquidity or we have a need to be able to have some type of event where we can get our hands on this and you can't, it could potentially cause a problem. Another issue that we see within the PPMs, and a lot of our analysts that review these PPMs have been highlighting and taking a look at, is the issue of hidden fees. Okay, so a lot of times the markups are disclosed, but they can be hard to find. And I know the PPMs, it's a thick document. We've got some that are a couple hundred pages. We've got some that are several hundred pages. It's a lot to read, but it's very important to dive into it. And we also understand at K Properties that, most folks do not have necessarily the time to be able to really sit down with a highlighter and a pen and underline and figure out, okay, well, this is saying this and this is saying that. So we're obviously it's not, we're not going to find everything or see everything or predict everything about what could impact an investor's money negatively, but we are going to definitely pay attention to the ins and outs of what's going on in these PPMs. And one of the issues that we've seen buried in here is that there are hidden markups and fees that are not necessarily the easiest to find. Now, traditionally, when you look at a DST PPM, we always encourage our investors to not only just read the whole thing, but also pay attention to the estimated use of proceeds page, because this is where you're going to see a lot of the fees that are associated with syndicating and bringing these and operating these investments. Okay, but sometimes, especially with what we're seeing with some of the REIT paperwork and some of the other different financial tools that are bringing these funds into the REITs, is that the estimated use of proceeds page excludes some of the markups. And this matters because, as an investor, you're trying to go in there oftentimes, looking for minimal fees, and you could potentially be unknowingly overpaying. The lack of transparency definitely leads to the potential for misaligned expectations and an increased financial risk. So what do? Well, work with a team that specializes in DSTs, okay? And I love the analogy that we put in here. It's one that I've tried to give to investors for a long time now. I was in the military. I had a good number of injuries, and I've had, at this point, close to a dozen different orthopedic surgeries, okay? I would never personally go to my general practitioner to perform, a knee surgery or a shoulder surgery. I would go to an orthopedist and a specialist at that within that particular field. Alternative investments, private placements, same thing. And way too many wealth managers and financial planners are selling up REITs, 721 processes to, their investors, and they're being given information that, understands the basics of how this benefits, but there's more below the surface that you need to pay attention to. So one of the things that we're doing is we're tracking which 721 UPREIT sponsors are marking up their DSTs and for what amount. We're taking a look at a lot of these fees that are discussed within the PPMs that might not be always super, obvious to most investors that are flipping through the pages trying to figure out what the business plan looks like and what they need to be aware of. And the reason why we're doing this is because, obviously we are specialists, we are leaders in the field, we've been doing this for a very long time. But the reality here is we want our investors to make informed decisions and to protect what they have, their hard-earned money, right? Like that's the ultimate goal here, is know what you're getting into. So ask the right question. That's a key part of this slide here. And understand that there are hidden markups. The 721 markups are going to impact your investment. And so some of the things that you can, maybe pose to your financial advisor or even your K Properties rep if you're, talking directly with us. But, one of the things you could bring up is this an affiliated transaction whereby the REIT already has owned the property and is now selling it to the DST investors? This is, we refer to a non-arm's length transaction. This is a red flag, and it could signal a hidden markup. And here's why: because if they're selling it, and again, we've seen this when we take a look at when we've taken a look at some of the history on these transactions, like how they're created, how how they become a property becomes a DST. Did the REIT mark up the DST price in the process? And some REITs we found can sell their properties to the DST at a 20% markup. And it's kind of shocking, but it does happen. And this is something that you should be aware of if this is a potential tool that you want in your toolbox, because that is definitely an inflated value, potentially an inflated value that you would want to be aware of, right? REITs and financial advisors may also claim no or minimal fees. Well, these things, they do cost money to operate, and they do cost money to be able to syndicate. And while markups quietly increase, investor costs oftentimes are much more than traditional DSTs. And it matters because it can signal that the asset underlying is overvalued, and a high markup is basically an additional hidden fee that could potentially reduce your returns on the investment. So what do you want to look for? You want to compare the property's prior valuation versus its 721 UPREIT DST sale price. So there, you're going to be able to see the discrepancy in the price, which is going to give you a little bit of insight as to how they're making the deal work. But also, the barriers for when that property or when down the road, how those properties are sold and how that profit's realized at that point too. One of the things, as we're kind of nearing the end of this, is the tax protection agreements. This is a little known and rarely discussed potential problem for investors that are inside of REIT. So what is a TPA, as we call it? It's a contract where the REIT agrees to indemnify investor tax liability if a contributed property in the REIT is then sold without a 1031 exchange. Okay, and many 721 UPREITs are going to lack a tax protection agreement, or they're going to have a short protection, 2 to 5 year period. And so what happens? What's the consequence here? Well, you as the investor can face a pretty sizable, potentially sizable, unexpected tax bill if the REIT sells a property prematurely and does not complete a 1031. You will find this language in many of the REIT PPMs. We're happy to walk you through it. We track these, but it is one of the potential casualties of being involved in a REIT. If a property does get sold and there is some type of tax obligation, it does get passed on to the investors. So a lot of times the REITs will, if they're going to do it, they'll put in a TPA, which is then they're basically committing to pay any tax bill that comes up for a certain amount of time. We track those. It's nice when they do it, but a lot of times, frankly, the TPAs are short, like they're 2 to 5 years, right? And again, if you're an investor where this is the end game for those funds, if you're going to commit, let's say you've got a $10 million exchange or a $20 million exchange or even $100,000 exchange, right? If you're committing those funds to a REIT for a long period of time and your TPA is only 2 to 5 years, and that money's going to sit there for the next 5 to 7, and properties are going to inherently, be sold within the REIT, you could potentially be facing tax bills that you were not expecting. And so that's one of the things that we've also keyed in on and trying to pay attention to make sure that you can be well aware of what's going on and the things that you need to expect when you're in this long-term marriage to a REIT. One of the case studies that we like to point to is the Archstone, the Empire State Realty Trust back in 2008. If you would like more information about this, you could probably Google and take a look at the basics of what happened there, but I'm happy to send you articles and case studies that we've done on this, and we definitely think it's something that investors should be aware of as they're looking at the possibility of completing a 721. Lastly, one of the things, well, not lastly, but towards the end here, one of the things that we've really been putting an emphasis on lately, you're going to see the updates on the K Properties inventory page, but we are identifying whether the UPREIT, participating in UPREIT is going to be a forced situation or optional, okay? You will, a lot of the large wirehouses for a lot of the larger institutions, the DSTs they're putting out are what we call forced UPREITs, meaning that when you go into it, you know that down the road, 2 to 5 years, whenever that process is going to unfold, you are going into a REIT, okay? And many are sold on this as a good idea because they're sold on the diversification, the tax deferral, the passive income, being able to have access to this massive portfolio of properties that potentially are being pitched as a way to shield them from problems and upheaval. And of course, the biggest thing, the liquidity. However, the situation could change. And what looks really nice right now, those REITs that have really good numbers right now and look like they're positioned really nicely for the next few years, they might not look so good. And things can change on a personal level too. We have a lot of investors where they allocate money towards something like this, in year 2025, and then you don't know what's going to happen in year 2030. Maybe that money or maybe that allocation that seemed like a good idea then is not. It's such a great idea when you find out 4 or 5 years later that the distribution is lower, the debt ratio is higher, and that there's more problems that have been created by persistently high inflation numbers. So these are things to consider. And as a result, K Properties is taking a look at this and taking a stance where we feel that optionality is something crucial and critical for our DST investors to consider. So not all DSTs are going to obviously offer the choice. On our website, you will notice that we have this laid out for you, so you will see it. If you have questions about that process, obviously talk to your K Properties advisor, so they can walk you through the different formats there and like what sponsor companies are doing what. But full 721 UPREIT optionality, it's important to understand it gives you the choice of whether to UPREIT or whether you don't want to UPREIT, versus the DSTs that will have a forced situation where you do not have a choice. So the Force 721 program, again, key things here, we kind of already covered a couple of it, but you're having, it's going to put you in a situation, it's going to put the investor in a situation where there's a lack of flexibility. Investors are locked into the UPREIT without the ability to then, change their decision, okay? The financial instability that can result if the REIT, let's say, takes on too much debt, it's then potentially putting the other properties and the overall health of the REIT at risk. And then the dividends. The dividends may be paid from borrowings or asset sales, but like we discussed before, they potentially can not be able to be sustained for the long term. Again, if we get to a point where, let's say a REIT is, like we're seeing right now in the industry, where redemptions are across the board on a lot of the major REITs that we're seeing and paying attention to, the redemption requests from the investors are far outpacing the income that's coming in. And so again, if you're in a 721 forced UPREIT that's slated to go into one of these, great news for the REIT because now they're getting your money that's getting put in. Bad news for you if it's locking you out or putting you in a position where it's difficult to get that money out. That was the whole reason why you're going in there in the first place. So let's see here. Okay. So again, just to kind of review and go through the things that we discussed, why the 721 due diligence matters and why it's so important. And again, we feel like it's essential. We feel like it's a necessary step and something that we want to help be a part of as you're looking at the different options, because there are a lot of options. If a REIT, if the end result of allocating a certain amount of money towards a REIT is something that you're interested in, do it the right way, ask the questions that we discussed, talk about it with your advisor, okay? Remember that the 721 UPREIT DSTs are not a one-size-fits-all investment. Each one is going to have its own risks, okay? Many financial advisors and wealth managers are going to recommend investing in an entire exchange. And this is one of the things, if you've talked with K Properties before, you understand how risk adverse we approach putting together these portfolios. Like, our ideas on diversification are designed to make sure that, our investors can weather economic storms and changes. And we feel that by diving into this and taking a look at the numbers and the metrics that we've discussed in this presentation, that we're going to potentially be able to hedge against a lot of that. Unfortunately, many financial advisors and wealth managers are, they have to manage a lot of money, that, they have to know a lot about a lot of things. And sometimes diving and going deep underneath the hood is not always something that they're going to be doing. So ask the right questions. And if you're not getting the answers you want, reach out to your K Properties investment advisors. This is what we do. And we are happy to be your orthopedic surgeon, right? So skipping due diligence on 721 investments could potentially lead to reduced dividends, leverage issues, overpaying because of the markups, and the unforeseen tax bills. Investors have got to look beyond just the relationship that they have with a financial advisor or a wealth manager, and analyze the actual financials behind the REIT for where they're doing where their money in this exchange could end up at. Okay, and again, as a specialist in the DST and 721 UPREITs arenas, we've got teams of analysts here at our headquarters building out here in Southern California that are dedicated to tracking these metrics. It's something that not only are we passionate about, but we're passionate about protecting our investors from. Okay, and so that's a big deal here, and we definitely want to talk with you more about it as questions come up. So again, take a look at the KPI1031.com marketplace. This is, you're going to see some of the changes. You haven't been on there recently. You'll see some of the changes to our inventory page. We are updating the website, and you're going to see the notes on there from the analysts about the different holdings, but also identifying, key things that you should be aware of, like forced versus optional, and any type of issues that are popping up during our own internal due diligence that we're doing. Let's see here. Okay, and I think that basically wraps everything up here. So the other thing that you'll also notice that's important to take note of, on our education section, when you log in on the back end of our website, you're going to see right alongside the current inventory list, you will also see a ton of educational materials, videos, different articles that have been written, case studies on these 721 issues that we've talked about, and different ways for you to be able to handle them in your exchanges. And then, of course, reach out to your K Properties representative with any additional questions that you might have about this process. We're happy to help. Here's our beautiful team here standing by the ocean. Again, we're standing by to assist any way that we can. And even if it's just to bounce questions off of our team who does this on a daily basis, if you're actively involved in an exchange and just have questions that aren't being answered, or you want details that are not being brought to attention adequately, please reach out. We'd be happy to help you. Thank you guys so much for your time, for joining us this morning, and hope you all have a wonderful, wonderful rest of the week.